Hi, this is Karen Lin. In this video, I'm going to introduce consolidation with the worksheet when NCI is present. This is an example on the textbook, and it's also on my notes. Assume on 2014 at the beginning, King acquires 80% of pawn for its 100,000 outstanding voting stocks, 80% of those for 9.75 each share, or a total of 780,000 cash consideration. Another 20% belongs to NCI, and the stock is traded at average of 9.75, which means the parent and NCI pay the same price. So from the previous lecture, we know this means that the parent and the NCI are paying the same price, that the parent has no control premium, they did not pay any control premium to acquire the share of the subsidiary. So before acquisition, we can see that this is the financial status of the two firms. You can see that the parent, this is the subsidiaries book value, the net asset is 780. The fair value of this asset is 950. The difference is 210, okay? Which means the fair value excess comes from the trademark patent. There's an overvalued equipment, which means the book value is higher than the fair value. And then there's a overvalued long-term liability. The book value is greater than the fair value. Okay. And during 2014, the subsidiaries retained earnings increased by 70,000. What does that mean? Okay, this you have to think about what does retained earnings increase means. During 2015, the subsidiary announces the net income of 90,000 and dividend 50,000. How is this piece of information related to this piece of information? The answer is, when we talk about retained earnings increase, it increases with net income, decreases with dividend. So this piece of information basically tells us the net difference between net income and dividend in 2014. Why do we need this information? Because when you're trying to calculate an investment account, the balance of an investment account, you need to know the net income and the dividend announced by the subsidiary. Okay, so the first step of our consolidation is to allocate the total fair value of the parent of the subsidiaries, the parents and the NCI's consideration transfer to acquire the subsidiary over its book value. So altogether, it's 9.75 per share, and the parent has 100,000 shares altogether. So the total fair value of the subsidiary should be 975,000. The total book value, as we saw in the blue sheet, is 740. So this is the book value, and the rest is the fair value excess. The fair value excess can be allocated to all different assets and liability which has a fair value excess, including trademarks, patent, equipment, and liability. Now, for all those assets and liability with the useful life, limited useful life, we need to amortize the fair value excess as the parent. So when I say we, I mean parents, because we stand in the viewpoint of the parent. We are the parent's accountant. So why does the parent pay more than the book value of the subsidiary suggests? Because the subsidiary's asset and liability has some fair value different from the book value. Also because the parent believes that in the future there is a synergy between the parent and subsidiary. Now note that this also applies to the NCI. When we are calculating this, this is all on the 100% scale. Some of my students will calculate this at like a 80% scale because they said the parent owns 80% of subsidiary. That would be incorrect. When we consolidate, we always consider 100% of the asset and liabilities. And if you watch my video 1, the parent always consolidate 100% of the subsidiaries' asset and liabilities. So when we consider their fair value excess, it also has to be 100%. Also applies to the goodwill. All right. So next, we need to allocate the total goodwill between CI and NCI. Um, the transfer by the CI is the 9.75 multiplied by 80,000 shares. That's 780,000 cash. We talk about in the information section. And NCI pays for the rest, obviously. So the total is 975. Fair value of net identifiable assets, which is 950. How do I know 950? It's from the blue sheet. The fair value of net identifiable asset, which means all the assets minus all the liability at the fair value except for goodwill, because goodwill is not identifiable. So when we talk about fair value of net identifiable asset, it is all other assets fair value except for goodwill. So that's 950. The parent has 80%, the NCI has 20%. So 80% is 760. 780 minus 760, that's 20,000 goodwill. NCI has 5,000 goodwill. If you look at the proportion of it, 20,000 divided by the total 25,000, it is 80%, which means when the parent does not pay control premium, the goodwill is allocated to the parent by the ownership by its ownership to the subsidiary. Again, the 20,000 represents 80% of the total goodwill, which is also the percentage of the parent's ownership. This is because the parent didn't pay any control premium to acquire the subsidiary. Next, we look at the balance of the investment account and equity in subsidiaries earning account. The investment account start with the payment that the parent paid, the cost, plus we usually need to plus the net income minus dividend, right? But we don't know this two pieces of information. Instead, we know the retained earnings changes of the subsidiary, which is 70,000. 80% of 70,000 is 56,000. So this is 80% of the retained earnings change of the subsidiary. That would be added to the investment account. And then minus 80% of the amortization of the fair value excess. Where do we get this 80% of amortization? It is from here. So this is the total amortization of fair value excess. The parent owns 80% of it. So you will see that the total cost plus 80% retained earnings change minus 80% of amortization plus 80% net income of the 15, 80% dividend 15, 80% amortization. That gives you the ending balance of the investment account. I want you to pay attention to the beginning balance of the investment account and the ending balance of the investment account. Equity in subsidiaries earnings would be only the current year's, which means 2015's 72,000, which is 80% of the net income of the subsidiary, and then 80% of the amortization of the subsidiary. That gives us 64,000 equity in net income at the end of 2015. Now, this account does not accumulate. It's unlike the investment account because this is an income statement account. In this chapter, we introduce two sets of accounts, which mirrors the investment account and the equity in subsidiaries earnings account separately. But these two accounts, I want to emphasize, they don't exist on the book. They are for our convenience to calculate ending balance of NCI and the balance of NCI in subsidiaries net income. You will see why this is useful when we do the worksheet approach. So if you look at the NCI account mirrors, NCI means non-controlling interest. It's an equity account. It mirrors the investment account. It starts with the cost that the NCI paid, which is 9.75 shares per share multiplied by 20,000 shares. So that is the total cost that NCI paid. 20% of the change of retained earnings for 2014, 20% of amortization. Okay, that gives us the beginning balance of NCI of 15. And then adding 20% net income, subtracting 20% dividend paid by the subsidiary in 2015, and then subtract the 20% of amortization, which is the same basically every year, unless one or more asset runs out of its useful life. Otherwise, they should be the same. That gives us the ending balance of NCI to 13,000. NCI in subsidiaries earnings is the same. It's the net income minus amortization, but also 20%. That gives us 16,000. Now you can see these two accounts perfectly mirrors each other, right? But these are just for our discussion purposes. You can use these T accounts to derive your NCI and NCI net income very conveniently. So this is the 2015 financial status of the parent and the subsidiary. This is basically 2 years after the acquisition because acquisition happened on January 1st, 2014. 2 years after, this is the income statement of both companies, retained earnings statement both company, and then the balance sheet. Okay. Now in the next I'm going to switch to the Excel, and then I'm going to use the worksheet to format to discuss. So this is the worksheet. The first two columns are coming from the blue sheet I just showed you in the documents. So these numbers I copy and paste to these two columns. And there is a debit and credits for the adjustment, and there is an NCI column to calculate the NCI beginning and ending balances. I also have a predicted column for myself just to predict all the numbers and see whether my consolidated numbers are the same with my prediction. Let's first look at the prediction of the income statement. So when we talk about prediction, it is basically the intuition behind each number that you're going to report to the outside investors about the status of the firm, the parent company, or the parent company, the entity that the parent company controls. So, for example, for revenue, how much revenue has the parent earned during the last year? It is basically the parent's revenue plus the subsidiary's revenue, which because the subsidiary is controlled by the parent. So we need to add them all. And also, this is not the first year. This is not the acquisition date consolidation, which means at the first date of consolidation, the revenues should be consolidated. So that's the parent plus the subsidiary. It is the same for the cost of goods sold because both companies incur the cost. For depreciation, theoretically, it's also the parent's number plus the subsidiary's number. However, we notice that there are some assets and liabilities. If you look at your allocation table, you will see that there are some assets and liabilities have amortization. Which one is associated with depreciation expense? It is the equipment. So equipment was overvalued, which means the subsidiary takes the depreciation according to the book, which is overvalued. So they take too much depreciation expense that we need to reduce. So the number we need to reduce is 1,000 per year. That's why it is I'm going to do it again. So it is the parent plus the subsidiary minus 1. Okay, so that's 79. Amortization expense is the same thing. We go back to our allocation table, look at any amortization of the fair value excess would be associated with amortization expense. Now, patent is an intangible asset, so it's associated with amortization expense. This is a fixed asset, so it's associated with the depreciation expense. Long-term liability would be associated with the interest expense. So there's an undervalued patent, which means the subsidiary takes amortization based on the book value of their patent, which is too small. So they took too little amortization expense compared to the fair value of the patent. So we need to add to their expense because they take too little expenses. So it is the parent plus the subsidiary plus the 6,000 amortization for the amortization expense. Interest expense, it's the same thing. We go back to the allocation table. It is a 5,000. So we are going to add the 5,000 to it. Okay, that's 120. Equity in subsidiaries earnings, when we consolidate it, it's always zero because it's an internal account that we want to eliminate. Net income. Net income is not added up by the parent and subsidiaries net income. So I'm going to jump to this consolidated net income because when we talk about in this NCI situation, we will have the consolidated net income that's split it between the CI and NCI. So consolidated net income is always the above, calculated from the above. Okay, that's 416. Now you can see this 416 does not equal to the parent's net income. In our previous chapter, we said that the consolidated net income would be the same as the parent's net income. It's no longer true because we have an NCI who shares this consolidated net income. What is the NCI in subsidiaries net income? This is the NCI's share of the subsidiary's net income, which is also the consolidated net income attributable to NCI. That means we have the total net income 416, a portion of it is attributable to NCI. That is the NCI's share in the subsidiary's net income. Pay attention, NCI does not share CI's net income, so you won't see its NCI's share in the parent's net income. That wouldn't exist because NCI does not hold the shares of the parent. So how do I know this number? Okay, when I'm trying to predict it, how do I know this number? Now this comes back to my previous talking point. When we look at the NCI in net income account, it mirrors the equity net income account. So we basically can calculate NCI net income, that's 16,000. So I'm going to write down 16 here. Okay, that's the 16,000 attributable to NCI. Now the rest of it will be attributable to CI. So 416 minus 16 to be consistent. I'm going to write it in a parenthesis, which means a credit. It's a subtract from the 416. So 416 subtract 16, that's 400. Okay. In some other books, this may be written in the number without the parenthesis, but they add these two numbers up. Anyways, you should understand the total consolidated net income would be attributable to NCI and CI. So the NCI's number plus the CI's number should equal to the total net income. Now you can see this net income attributable to CI equals to the net income that the parent reports. That's consistent with what we talked about in our previous chapters. The consolidated net income equals to the parent's reported net income. Here is the consolidated net income that attributable to CI would be equal to the parent's reported net income. Next, let's look at the statement of retained earnings. The consolidated statement of retained earnings, as we have discussed before, it should be only the parent's retained earnings. So I would just put the parent's number to it. Notice that the net income number in the statement of retained earnings equals to the net income numbers that attributable to CI, okay, which is also the same as the CI's reported net income. Dividend, only the parents, and imbalance would be calculated from the above. Now, again, why does all these numbers equal to the parent's number when they're consolidated? It's because the parent's shareholder is the only shareholder of the entity. So when we talk about the retained earnings, we are talking about the retained earnings in the perspective of the shareholders of the parent company. So the consolidated number should be equal to the parent's number. From another perspective, it is because the subsidiaries stockholders' equity should be canceled out with the parent's investment account. So that's the mechanical reason. Balance sheet. Most of the accounts have, when they're consolidated, would equal to the parent's number plus the subsidiary's number. Okay. I'm just going to do a scroll down. But when we look at the trademark, right? So I copy and paste all the formula below. But when we talk about the trademarks, you would say, wait a minute, there is a fair value different from the book value. An acquisition method requires us to add the parent's book value with the subsidiary's assets using the fair value, which is correct. So I'm going back to my allocation table. My trademark is undervalued by 60,000. So this number would be the parents plus the subsidiary plus the 60,000. Okay. Patent. Patent is the same thing. It is 120,000 undervalued. So we need to add this 120,000 undervaluation of the assets. Okay, but is that it? No, because after 2 years, if we look at the information section, after 2 years, it was amortized by 2 years, each year by 6,000. So I'm going to subtract 2 years amortization of 6,000 per year, right? That is the correct number of my consolidated patent. The same thing with my equipment. I do parent plus the subsidiary, but the number should be, we should be adding or subtracting its overvalue. So we need to subtract 10,000 from it, but we are adding back 2,000 because 2 years after of amortization. So I'll be subtracting 10,000, but I'm adding 2,000. If you combine the 10 and 2, that's 8,000, right? So I'm actually subtracting 8,000, which is the remaining fair value excess of my equipment. So that is the consolidated equipment should look like. Consolidated investment, 0. Consolidated goodwill, we go back to the allocation table, it is 25,000. Okay, so that's 25. Total assets would be everything from above. Okay, that's the total assets. Liabilities, it would be the parent's number plus the subsidiary's number. Okay, but because the subsidiary's long-term liability is overvalued, so which means it is overvalued by 40,000 minus 2 multiplied by 5,000, that's 10,000. So the remaining overvaluation would be 30,000, right? 30,000 overvalued, which means it would be the 590 minus the 30,000. So I'm going to notice that they're on the credit side. So again, they're on the credit side, so they're all negative numbers. If you want to subtract something from the negative numbers, you need to add to it. So I'm adding 30. Okay, common stock, only the parents. NCI at the beginning. Okay, NCI at the beginning, it is from my T account. I can see NCI at the beginning 207, NCI at the end 213, right? I'm only going to report NCI at the end, so that's 213. Okay, it's on the credit side because it's an equity account. Retained earnings, only the parents, or it from the above, from here, ending balance. Okay. Total liability plus the holder's equity would be all these numbers added up. So now I can see my total liability plus the holder's equity equals my total assets, so I'm fine. So that is the prediction of the accounts. I'm going to break this in a separate video. In the next video, because I worry it's too long, would be unable to upload to the YouTube. So next video, I'm going to talk about the journal entries. I mean the adjusting entries that we are going to use in the worksheet. I'll see you in the next video.